important here, you can see, is that in 2020, when we started that big print, gold smelled it, knew it, understood it, and took off. I remember it well. Gold went from, the 1,900 area, 1,800 area, and shot right up to $2,000. And all my stocks that I was invested in went crazy. And Bitcoin just sat there for quite some time with a real lag. And I was kind of like, wow, what's going on? And then suddenly Bitcoin woke up and it went from 10 to 60. So it went up 6x. So the historical pattern, and I retweeted Terrence this morning on this, the historical pattern is gold moves first, then Bitcoin follows harder. I am of the opinion that sometime in the next 6 months, Bitcoin is going to wake up and shock everybody. And that we're going to very quickly move through this 90, through the 100, through the 124, whatever the last top was, and into kind of the 150 to 200 zone. I think that's coming.
For months now, the global economy has been whispering a truth most investors still don't fully appreciate. Central banks, led by the U.S. Federal Reserve, have shifted from tightening to sweeping easing, even as inflation remains well above target and markets are still stretched. In December 2025, the Fed delivered its third consecutive rate cut this year, pushing the benchmark federal funds rate down to a new cycle low, and announced the resumption of $40 billion per month Treasury bill purchases to manage liquidity in the system. These moves aren't isolated technical adjustments. They're signals that the era of monetary restraint is ending, and a new phase of persistent accommodation is beginning. Few voices have warned more forcefully about what this pivot means than Larry Lepard, author of The Big Print and longtime market strategist. Lepard argues we are not simply ending quantitative tightening, we're at the early stages of what he calls the next big print, a multi-trillion-dollar expansion of money and credit that will define this decade's macro narrative. In his book and in his latest interview, he lays out the framework. Past big prints, from the 2008 financial crisis to the COVID crisis, were born of financial stress and crisis. Now, he says, the groundwork for the next wave is being set in an environment of stubborn inflation, record deficits, stretched valuations, and policymakers increasingly trapped between weak growth and rising price pressures. The result, he warns, is not only more easing, but a much larger structural reinflation than markets are pricing. Lepard draws on history to make his point. In the big print of 2020, gold was the first to wake up to monetary debasement, rocketing from sub-$1,000 levels to above $2,000 as real money poured into hard assets. Bitcoin lagged initially, trading sideways, before finally breaking out and climbing sixfold from $10,000 to $60,000. That sequence, gold leading, Bitcoin following with greater amplitude, is not random. It's a reflection of how markets digest liquidity and how investors rotate toward sound stores of value when confidence in money erodes. Today, Lepard believes we may be on the cusp of a similar awakening, but on an even broader, more powerful scale. And that's exactly what we're unpacking in this video. Why the Fed's latest moves, 3 rate cuts and renewed liquidity operations, may mark the beginning of the big print in earnest, and why this matters for gold, Bitcoin, and every serious investor's portfolio. So before we dive deeper into Larry's timeline and the underlying mechanics of this next cycle, make sure you hit like, subscribe, and turn on notifications so you don't miss any of this vital analysis. Drop a comment below with your thoughts on where you think Bitcoin and the entire crypto market are headed next. Thanks, and enjoy the video.
When did the big print start, or is this the beginning of the big print?
Yeah, well, the labels are fuzzy, right? I mean, one could argue it started with the creation of the Federal Reserve. One could argue it started in 33 when they grabbed the gold, or started in 71. I mean, but the way the way I look at it is, I think that 2008, what you're talking about, the GFC, was what I think kicked off the fourth turning, and I think that was obviously the first big print. The balance sheet went from 800 billion to 3 trillion over a number of years. And when it was at 1.3, Bernanke testified to Congress that, he was going to bring it back down. And Ron Paul said, I don't think you will. And of course, Ron Paul was right and Bernanke was lying. And so that was the first big print. Then there was a second big print with COVID, when the balance sheet went from somewhere in the 3s to close to 9, maybe a touch over 9 before they started to taper it again. And so So we've really had two big prints as measured in kind of modern terms. And then we're just now pivoting into what could be the third big print. I want to emphasize, and Lynn and I have had a friendly back and forth on Twitter about this. I mean, she says we're going into the gradual print, and she's right. I mean, the last couple, both of those prior events occurred as a result of a financial shock that required them to bring, money hoses of liquidity quickly and aggressively to get it under control. And so, the balance sheet went up, 3x, the balance sheet went up another 3x kind of thing. Right now, as we all know, what's happened in the last month, and certainly really even with the last few days, because the Fed meeting was just earlier this week, is that they've announced they're stopping quantitative tightening, which they had kind of signaled that for a month now. Yeah. They've actually stopped that, and then they were flat for a while, and now they've actually agreed that they're going to not engage in what they call QE, which, it's all a matter of definition, but they're going to engage in what they call reserve management, which is to say they're going to buy $40 billion worth of Treasury bills, at the Federal Reserve on a monthly basis in order to keep the reserve balances large enough to make the system work. And I've said in the book, and I've said overall, in general, I mean, this had to happen. This is a mathematical certainty. The government didn't want it. The Fed didn't want to do this, but they had to do it because otherwise they would have had a repo blowout like they had in 2019. And so, let's say it stays at 40 billion a month times 12, that's 480. Well, that's not the 3 trillion or the 5 trillion that got printed in the last two. That is, as Lynn has said, that is the gradual print. But, you've got to start somewhere. And if you'll recall back to 2019 when the repo blowout took place, they started a gradual print that, was of similar size. I think it was about 50 billion a month. Maybe it grew to 70. And then COVID hit, and then it went crazy. And they just printed enormous amounts. So I would argue, as I said in my tweets back to Lynn, that yes, you're right. This is a gradual print, but it could easily morph into a big print if something breaks.
Unless we have some type of an unprecedented event.
Well, that's the thing. I mean, if you remember 2019, I mean, they had to keep stepping it up. I mean, what we'll have to see is is this enough? And it was interesting because they floated some trial balloons on this and they were in the 20, 25 billion size. And then they said, well, no, let's play it safe. Let's go for 40 and maybe we can bring it back. And I think in reality, what's more likely to happen is they're going to do 40 and 40 is not going to be enough. And so 40 is going to become 60 and 60 is going to become 80 and off we go into the big print, right? The housing market isn't likely to be the epicenter of the problem this time. I mean, the last one was really driven by just absolute craziness in the housing market, which was documented in the movie The Big Short. So it's likely to arrive, from some other area, but there is a lot of leverage in the system. And what I find most interesting is that they've pivoted to printing money, perhaps gradually, as Lynn says, but arguably it'll have to be more than that. But they've done so in an environment where inflation is still high at 3% and where the stock market is at a record level, and where the bond market is relatively calm and where the economy is, kind of punk, but hanging in there. So, what I would suggest is that what's going to make this things, transmute from a gradual print into a big print is one of those other conditions is going to change. The stock market is going to roll over, or, the employment situation is going to get worse, or the CRE loans are going to start to bubble up to the surface and get recognized, or the banking system is going to feel strange. I mean, the AI bubble is going to burst. I mean, they're saying a lot of the GDP growth that we're experiencing right now is all because of the growth of the AI data centers, which can't even get enough electricity. And, if and when that, and I'm not saying it is a bubble, it feels like a bubble to me, but who knows? AI is important. AI is going to change the world. I get all of that. But just like the .com thing, that was important. That was going to change the world too. And it got way ahead of itself. That's how this feels to me. And so when one of these things change, we're running a $1.8 trillion deficit with full employment and a record stock market. When, in 08 or in 2020, when the stock market went down substantially, in both cases 50%, and unemployment went up substantially, when the deficit completely blew out. So 1.8 trillion of deficit could go to, 3, 4, 5, 6. I mean, it could make COVID look small. And So now instead of having to roll over $9 trillion worth of bills, we've got to roll over $14 trillion worth of bills. Well, guess what? The bond market's going to break. And so to me, the alarm to watch in this whole thing is the US 10-year yield, which is just broken. If you kind of look at on a recent basis, there's a nice chart done by, I think it was Jim Bianco, who showed kind of, it was in a downward trend over time, and we just broke out from that trend. And so, if the US 10-year starts to head to 5 or 6 or something, then they're going to know that, oh my goodness, this is not enough. We cannot continue to do this without printing even more money. And where we're ultimately headed, I believe, is yield curve control. So, and yield curve control is nothing more than QE, where the Fed say, the Federal Reserve says, we are going to buy these bonds and not let the rate go above a certain level. And that's fine, but at some point, when the bond market realizes that inflation is certain to have another wave up and continue, the entire bond market's going to look at the Fed and say, sold to you. Here you go, 37 trillion sold to you, Fed. And then the Fed balance sheet, which went from 800 to 3 trill to 9 trill back to 6, it's going to go from 6 to 15, because some big piece of that bond market is going to want to sell. And the reason they're going to want to sell is because, guys like Donald Trump and Hassett and Miran and everybody else. I mean, Trump tweeted the other day, he wants to see 25% growth in GDP. Yes. Well, you can get 25% growth in GDP. All you got to do is get 20% inflation and 5% real growth.
Right.
I mean, and that's kind of what they're saying. They're going to run this thing hot. And so, woe be it to anybody who doesn't own silver, gold, or Bitcoin, because, or real estate, because, we're going to have another wave of inflation.
Lepard traces the big print back to the 2008 global financial crisis, when the Fed's balance sheet exploded from roughly $800 billion to over $3 trillion in a matter of months. The first real big print in modern memory. The next came with COVID, taking the balance sheet to nearly $9 trillion as global policymakers unleashed unprecedented liquidity. Today's environment, where the Federal Reserve has stopped shrinking its holdings and transitioned to active purchases again, may not yet match those explosive expansions in scale, but Lepard argues the dynamics are increasingly similar. Liquidity stress, vulnerable credit markets, and policymakers trapped between supporting growth and containing inflation. If a true crisis hits, he warns, this gradual easing could rapidly morph into full-blown big printing once again. This is the context investors must understand if they're to read the macro winds correctly. But that's only one piece of the puzzle. Next, we transition into how Lepard diagnoses the current mechanics of this shift. Not just by looking at Fed policy actions, but by reading the warning signs in bond markets, credit conditions, and the very structure of yields across global financial markets. For Lepard, the crucial question now isn't whether easing is happening, it is, but when and how this shifts into a broader inflationary wave that compels central banks to embrace yield curve control and an even more aggressive big print. Let's take a closer look.
This decade is going to remind people of the 70s, where inflation came in waves. You had the first wave and they tightened, they got it under control. We went to 9 on COVID. We brought it back down to 3. Couldn't quite get to 2, fine. But now, we've got the midterms coming up, 2026, and Trump's going to want to win those, so he's going to hand out stimmy checks. I mean, he's already talking about $2,000 stimmies to middle to lower income people, as a reflection of what he's gotten out of the tariffs, and that's going to be inflationary. And Moran and Besant and the Fed board are going to try and get the interest rates down. And that's going to be inflationary. There'll be a wave of housing refis, which will be inflationary. And, off we go. And so I think in the next run up, inflation, I mean, if we have this big print that I see unfolding in the next 2-3 years, the next wave of inflation could take us to 10, 12, 15% inflation. So it's really quite a mess.
What the hell is going on? Why is the price not correlated anymore to the interest rate reduction? Where should we be looking for more Bitcoin positive price action?
Yeah. So the problem with Bitcoin is that it's a couple of different things. It's the best form of money to protect from monetary debasement, because it's even sounder than gold in terms of stock to flow. And it is, in my opinion, it will be the future of money over a long enough time frame. But sadly, it also has some correlation with the stock market, although it broke that recently, which is interesting. And it broke it in a way that I didn't expect, which is the stock market's held together and Bitcoin's gone down. But probably the most important thing that it is it's a liquidity indicator, because it's very easy to trade, and it reflects how much money is coming into the system. And although we took rates down, and although they're going to start to print again, it is gradual. And the other thing that happens is it tends to historically not reflect that liquidity until there's a lag with gold. And so what's happened here is, this has been an unusual year, because I think the world has woken up to the fact that, Doge didn't work. Monetary debasement is a real thing, and it's going to continue for years, if not decades, but certainly years, until we reset the monetary system. And so if you believe that to be true, which I do, then you need to protect yourself with things that can't be printed, and gold and Bitcoin are the two most logical ones. And gold is much more widely known, understood, distributed, held by governments, held by corporations, et cetera. And so it's natural that when everyone wakes up to that issue, they go to gold first, because look, there's a whole, we all think Bitcoin's obvious, but, frankly, a big piece of the world doesn't fully get it. And so, what you see is that Bitcoin tends to lag gold. And this is a really interesting chart. Now, this is actually moved to lag the Bitcoin prices in orange, gold prices in white, but and this shifted it over a little bit. But one of the things that's very important here, you can see, is that in 2020, when we started that big print, gold smelled it, knew it, understood it, and took off. I remember it well. Gold went from the 1,900 area, 1,800 area, and shot right up to $2,000. And all my stocks that I was invested in went crazy. And Bitcoin just sat there for quite some time with a real lag. And I was kind of like, wow, what's going on? And then suddenly Bitcoin woke up, and it went from 10 to 60. So it went up 6x. So the historical pattern, and I retweeted Terrence this morning on this, the historical pattern is gold moves first, then Bitcoin follows harder. And you can see that in several different cases. I mean, you can see where, in 2022, where gold started moving higher and Bitcoin sat flat, and then Bitcoin came ripping past it. I guess my point is, I am of the opinion that sometime in the next 6 months, Bitcoin is going to wake up and shock everybody. And that we're going to very quickly move through this 90, through the 100, through the 124, whatever the last top was, and into kind of the 150 to 200 zone. I think that's coming. I mean, we're below the power law model of where it should be right now. And, I think and what I think is going to drive that is the big print. I mean, I think what we just saw, we're still if you kind of compare this to 2020, we're still in the early days of the monetary ship turning. It's gradual, right? Lynn's right. We've got the gradual print, 40 billion a month. But let's see if 40 billion does it, or let's see if that has to get bigger. I mean, the history of these things is that when there's a problem, they start small, but then as the problem gets worse, they have to go bigger. I mean, a good example of this recently, remember when they went in with a swap line for Argentina? It's the Argentina peso was falling apart, and the U.S. for strategic reasons wanted them to be our friends versus China, and said, well, that's fine. We'll support you. We're going to give you $20 billion.
20 billion? Yeah.
Yeah. Well, about 3 weeks later, 20 billion became 40. So, and I don't know where they're at now, but my point is that, the big print starts with a gradual print, and we'll see. Let's see. Does the 10-year stay where it is or not? Does the Japanese 10-year calm down? I mean, that's another, there are a lot of signs. There are a lot of warning signs out there. If you get on your TradingView account, you look at the Japanese 10-year, you look at the German 10-year, I mean, they're both pushing up against record highs. And so, the bond market is basically your fire alarm for what's going on here. And we know mathematically and factually that the U.S. government cannot exist with yields getting higher than they are right now. I mean, they've already said that by announcing that they're going to start buying and printing money to the short end of the market. But if the long end of the market starts to suffer and yields start to trend higher, well, that's what will trigger the big print. And my guess is it's 6 months. can't be more than a year. It's going to happen sometime. And even let's say it's even 6 months. I mean, in May, Powell's gone. I mean, Powell's trying to be Paul Volcker. He can't be. Powell wants to be Volcker. He can't be. He's going to be out of there. And they're telling you. I mean, it's like when they tell you who they are, listen. I mean, Moran thinks rates should be 2%. Trump thinks rates should be 1%. Hassett thinks rates are way too high. I don't know what that means, but they're too high. I mean, we're going to a lower rate environment.
When you step back and connect all the signals flashing across markets right now, Larry Lepard's warning starts to look less like a bold prediction and more like an inevitability. The Federal Reserve has already told investors who it is and what it intends to do. After 3 rate cuts in 2025, the Fed didn't just pause quantitative tightening, it quietly replaced it with reserve management purchases, committing to tens of billions in Treasury bill buying every single month. Call it QE, call it liquidity management, call it semantics. The outcome is the same. The balance sheet is no longer shrinking, and the monetary tide has turned. Historically, once that door reopens, it doesn't close gently. It swings wide open when something breaks. At the same time, the fiscal side of the equation is deteriorating fast. Massive deficits during periods of full employment would once have been unthinkable, yet they are now treated as normal. The political incentives are clear. With elections always just around the corner, pressure on the Fed to keep rates low and markets stable will only intensify. Lepard's point is simple but devastating. The U.S. government cannot survive in a world of persistently high long-term yields. If the bond market revolts, if the 10-year yield pushes decisively higher, the Fed won't have a choice. Yield curve control becomes the only viable option, and with it comes an explosion in money creation that makes previous rounds of printing look modest by comparison. What's especially important is how big money is already positioning around this reality. Large institutional investors and hedge funds aren't behaving as if inflation is solved. Capital is rotating out of duration-sensitive assets and into hard assets, gold, commodities, and increasingly, Bitcoin. Spot Bitcoin ETFs continue to attract flows from professional allocators who understand that Bitcoin isn't just a speculative trade. It's a liquidity and debasement hedge in a system that requires perpetual easing to function. Billionaires don't need to announce that they expect inflation. Their portfolios do it for them. When long-term capital starts choosing assets that can't be printed over assets that depend on stable monetary conditions, that tells you everything you need to know. And this is where Lepard's gold then Bitcoin framework becomes critical. Gold is moving first because it's understood, liquid, and trusted by institutions and governments. Bitcoin lags until it doesn't. Historically, once liquidity conditions turn decisively, Bitcoin doesn't just follow gold. It overreacts to the upside. That's why Lepard believes the current disconnect is temporary. If the big print accelerates, whether due to a bond market shock, an economic slowdown, or political pressure, Bitcoin's repricing could be violent, fast, and shocking to anyone still waiting for perfect conditions to arrive. The real takeaway is this: markets aren't mispricing Bitcoin because the thesis is wrong. They're mispricing it because they haven't yet fully accepted what the Fed, policymakers, and the debt math are telling us. This decade doesn't resolve inflation. It manages it, in waves, through money printing and financial repression. In that environment, assets with no counterparty risk and no supply elasticity don't just perform well. They become essential. If Larry Lepard is even partially right, we're not early in a short-term trade. We're early in a long, structural repricing of money itself. Drop a comment below and tell me your thoughts on Lepard's super bullish $200,000 prediction for Bitcoin in 2026. If you found this breakdown valuable, hit the like button, subscribe to the channel, and turn on notifications so you don't miss what's coming next. Thanks for watching, and I'll see you in the next video.